The US national debt is a stone's throw away from reaching $37 trillion. And that's trillion with a T. And I think this is kind of interesting. The debt per citizen is around $108,000. So if anybody has $108,000 sitting around, hey, do your part to pay the debt. But the reason I bring this up is because whether it is a Republican or a Democrat that's in the White House, our system is built around the idea that the government will continue to spend into oblivion. And I'll tell you exactly why. At the end of the day, our system in terms of the government here in the United States is all about votes. In order to gain a political role, you need votes. How do you get votes? Well, you need sponsors. Sponsors have some sort of an agenda in order to fund you, whether that be, some sort of government spending agency or program over here or another one over here. And if you take out the Republican or Democrat side, they're both guilty of doing this. In order to keep your seat in Congress, in the White House, whatever, you have to do something that gets a lot of votes. And oftentimes, in order to get votes, you need marketing, you need spending. And so our system is built around a never-ending spiral of national debt. And the reason I bring this up is because this is part of the reason why for years now I have always been pretty bullish on gold from a big picture view. But I want to talk about gold now, here in June of 2025. Is it time to be buying gold at these levels because of the national debt concerns? Well, it's sort of been a problem for many, many years, and people keep kicking it down the road. But if we get some sort of big national debt crisis, perhaps further downgrading of the US credit rating, or for example, the economy slows and the government can't pay back its debt, gold could very easily in any of those circumstances rise dramatically. And in fact, $5,000 gold is a possibility in that circumstance because the dollar could lose a lot of strength if the economy falls apart. But do we have evidence of that right now? As traders, we're not just looking at things from a forever perspective, but rather a here and the now trading opportunities. Let's take a holistic view of the US economy at this time and see how things are going. So one of the core attributes to the economy is the state of unemployment rate. So if we take a look at unemployment in the United States, it came down, of course, following the COVID pandemic where we had a big spike in unemployment and has, not necessarily, it's not at its bottoming point here, but still relatively low at around low 4%, 4.2%. That's still a historically good level of unemployment rate. As we talk about often on this channel, a 5.7% long-term average is the unemployment rate in the United States. Of course, that takes into account good times, bad times, etc. And so at 4.2%, is our unemployment rate at a critical level? No. And if we take a look at the CPI, which is a measurement of inflation in the United States, you can see things have actually been overall falling here and getting pretty close to the Fed's target inflation rate of 2%. Wage growth in the United States also looks relatively healthy at 3.9%, outpacing the rate of inflation. And last week we had a decent jobs report with 139,000 jobs added compared to the expected 126,000. So based on what we just got done discussing, I would say that the national debt is still rising dramatically, but not in a critical point of view because the economy is holding up well. But here's something that is worth mentioning. You can see for the last few years, we've had very strong GDP growth here in the United States, hovering around mid 2s to 3s in terms of a percentage GDP growth rate. That's a pretty strong growth rate. And the reason this matters is, think about this. If you wanted to lend money to someone and their income was growing pretty well, it's a more stable loan to offer. But imagine if someone asked you to borrow money, but they had no income to show. That would be a much riskier loan. And so here recently with all the tariff stuff here, we have had some scrutiny, some uncertainty surrounding GDP growth. However, the reason we've had this big drop off is due to imports. We had a dramatic amount of imports hit the shelves here in the United States, trying to front run the upcoming tariffs that the market is now expecting. That does factor into the calculation of how GDP growth works, causing this to spike lower. However, in recent times, we did actually get a slightly better print in the preliminary GDP numbers that came out recently. The reason I show you these things is that gold is in consolidation right now. But if this story that I just got done telling you, for example, the jobs data or the inflation story starts to crack and break, this would make me very bullish on gold. So a couple things on the fundamental side. We want to look at inflation. We want to look at the labor statistics. We want to look at GDP growth to get an idea of the stability of lending money to the United States. At the end of the day, this is the ultimate bull case that I see for gold, is the national debt situation becoming under scrutiny, right? And how does that become under scrutiny? Well, it would happen likely when, like I said, you get a breakdown in the economy alongside high levels of inflation. That would be the worst case scenario and would create a huge demand for gold. So if you're somebody who's bullish on gold for those reasons, I would say that the timing is not quite right at this time. However, I'd be looking for price action breakouts above the previous high. There are a number of reasons that we could potentially see that breakout. For example, geopolitical things flare up between Russia and Ukraine, or in the Middle East between Israel and Iran, right? These things could happen that could cause gold to spike. But like I said, if you want to see something like a $5,000 price on gold, it would likely be, in my personal opinion, due to scrutiny over the US national debt. But at this time, the US economy seems to be doing okay for the most part, and we'll continue to watch to see if the efforts of things like Doge or the current administration, which has made big claims about working on the national debt, will come to fruition. We'll see, but to be honest, whether it's Republicans or Democrats, for many years they have made big promises that they have not been able to keep because of what I said at the beginning of this video. They are incentivized to continuously spend money to gain votes. And in my personal view, as long as that system remains, it will continue to cause the national debt to go up and up and up. The question, however, is can we outgrow the current national debt? That is a big claim of the Trump administration. Instead of trying to massively cut all the spending, the idea is that we can outgrow the national debt. But we've already been growing at a pretty strong rate in the 3% growth for GDP is a pretty strong historical rate of growth in an economy. So we've already been growing pretty strong, but the problem is we're spending way beyond our means. So that's always the back pocket bullish case for me with gold. But like I said, I would need to see those events start to break down, inflation to stay steady, but at the same time, unemployment rate to rise. Something worsening in the US economic story would make me very bullish on gold. By the way, if you're interested in checking out the trades that I am taking when I take them, whether it be on gold or something else, I share many different trades within our Signal service. If that's something that you're interested in, check this out. Currently, we're offering our biggest discount of the year. It's 40% off to join the VIP group. There's a link and promo code in the description if you'd like to explore it, or if you want to ask us some questions about how the service works. And if you stuck through my ad here, if you want to get 45% off, we'll give extra discounts to people who use the first link in the description down below to chat directly to our support team. Just let them know you were watching the video today and they'll get you an extra discount. So what about the dollar in all of this? Obviously, gold tends to move higher when the dollar looks really weak. And so if you do get the big economy of the world, the US economy, start to materially sour, let's say jobs data starts to really weaken and inflation is still a problem, there is that possibility that you could get a big fall through to the downside on the dollar. But is the timing right currently? Well, I would say that factors do generally favor bearishness on the dollar, and I'll show you why. When we take a look at the US economic heat map, which helps to sort of conclusively look at all of this data at the same time, all of these key economic metrics that we're talking at a high level about, we can actually see visually and categorize here what we're talking about. And what we can see is most of our indicators, like for example, PMI data, which is a forward-looking indicator of the economy, these things look pretty soft for the US dollar at this time. Under our US impact column here, most of our indicators are suggesting bearishness at this time for the US dollar. However, tomorrow we get the big CPI report. And this is what I really want us to focus on this week, because if we get a CPI report that is hot or higher than expected, that could cause the US dollar to bounce back. But if we get a big miss, meaning a low inflation print, while that would be great for stocks because interest rate cuts would be coming, that would be very bearish for the US dollar. And that has been the case for the previous reported numbers. Back in May, we had a really cool inflation print compared to forecasts on both the CPI and the PPI, the producer price index and the consumer price index. So front and center this week is definitely the inflation statistics. So we'll keep an eye on those on Wednesday and Thursday to see how they deliver. So while I'm not trying to be a doomsday person by any means when it comes to this stuff, it is worth knowing what's happening with the US national debt and also keeping an eye on the key indicators of the US economy. This could lead us, if we get, for example, a cool CPI print, maybe a 2.4% or 2.3% CPI print, could send us through these lows, and we could see the next leg lower in this dollar downtrend that we've seen, which could get gold back to those all-time highs. By the way, I mentioned 2.3 or 2.4% because right now, consensus in terms of what we'll expect for CPI tomorrow is 2.5%. A cool print would be 2.4 or 2.3, right? Those would be, of course, less than what is expected currently, which is that 2.5% inflation read. So if you get less than 2.5, likely the dollar goes lower. I'm currently still in this Russell position. Things are going really well with this trade, and I've trailed my stop loss. I'm looking to trail further here. This one is also very sensitive to inflation. So if, for example, you get a good inflation print, meaning let's say a cooler than expected inflation print, that would be good for the rate cut story, and likely the Russell could continue to push higher. So I'm going to be watching inflation tomorrow to see how that could potentially impact my trade here on the Russell. If you get a big spike up in inflation, that could obviously do the opposite, causing the Russell to move lower, in which case I would stay in the trade as long as we can hold support around this general area. So I am still bullish on the trade here. I do think we have more upside, but I'll be watching CPI to see what delivers there. And Lutnick says the US-China trade talks that are going on in London right now are going well on the second day. Now, how could this impact markets? Well, if the tariff situation starts to look more and more promising, meaning deals start to come through, stocks are likely to continue higher. And how would that impact the dollar and gold? Well, the dollar likes positive developments when it comes to tariff news, and gold dislikes it, right? Positive developments mean peace and security, and gold thrives on chaos. So in terms of a catalyst for gold to get another move like this, where we just shot to the upside, and this was one of my best trades this year, was catching this move here, for us to get another leg like that to the upside, it would probably come off of the idea that we are seeing trade deals materially worsen and or scrutiny around the national debt and US economy. Those are some of your upward catalysts for gold that I personally see right now that could potentially be around the corner. But not that I'm betting on them right now. I would be willing to buy into gold if some of those scenarios happened and we got some proper technical setups. And today's video is sponsored by 8cap. If you enjoy looking at the edge finder within my videos and you want a copy for free, stick around for a second. I'll tell you how you can take advantage of the special offer that they offer my subscribers. So if you head over to our website, a1trading.com/8cap, you can figure out all of their details behind this offer that they're doing. Basically, they will purchase a copy of the edge finder on your behalf if you follow the specific instructions on that page, a1trading.com/8cap. You can basically follow along there. But the basic idea is that you sign up and create an account, make a deposit exceeding a certain amount, and they will purchase the edge finder on your behalf. For more details, like I said, head over to a1trading.com/8cap. How is inflation going is to look at the direction of inflation, right? Similarly, when we're talking about interest rates, or we're looking at GDP growth or PMI data, what is very important not only to the statistic that comes out, but it's the direction that matters. And so markets are continuing to see this multi-year cool off in inflation that we've seen post-COVID. So tomorrow's print is expected to come in at 2.5%, right around here. Okay. Now, is that damaging to the big picture story here? I would say no, not really. Inflation still generally seems to be headed lower. But guys, the thing is now, for quite some time, inflation was like everything we talk about on this channel. We talk about, inflation's bottoming out, or it's still at 7%, 6%. Those were scary inflation figures. And for quite some time, the market has really paid close attention to the CPI report. Last week, however, I think you started to see a stronger shift towards a bigger focus on the labor statistics than the inflation statistics. Look, inflation is pretty evidently like moving lower. It's hard to make a case that right now inflation is already trending higher. Now, you may say, well, with those big old tariffs, if those go into play, we may see inflation really truly bottom out and start to move higher again. I hear you on that. That's very possible. Um, but right now, it's hard to say. Looking backwards, like, okay, look, we've had some incredible progress on inflation. So I think with the NFP report coming in, it didn't massively beat. We talked about this yesterday. The NFP report did come in better than expected, but it was not like some incredible beat. It wasn't like this monstrous outperformance, right? ADP missed expectations pretty sizably. Unemployment rate remained flat at 4.2%. This is still healthy. Unemployment claims went up last week. We'll see if they how they come out this week. So the jobs data is now kind of more in focus in my view, but you have cooling inflation, and that's a really good thing for the markets. Let's just take a quick look here in terms of the markets, see how things are moving this morning. You've got S&P 500 and NASDAQ again flat yesterday, very indecisive move. However, Russell's been moving. We're still moving and grooving on the Russell, which is great. I have a long position on the Russell. This has been a really good play for me here recently. I did trail my stop loss, took my stop, moved it up here just behind this doji looking candle here on the daily chart, but specifically on the 4-hour chart, I just liked this level of support, right? So we had kind of the big push back up to these highs, right? And we were able to actually break through that level. So when that happened, I just said, okay, take that stop, put it right here where we kind of built a base and shot off this level, right? So basically, I'm willing to continue to hold this position as long as we can hold this level of support. But as we continue to push higher here, things are now looking even more promising for the Russell. I may get an opportunity to trail a stop even further. But I really don't want to. I don't really want to crowd this trade. But I mean, I don't want to get too fancy with it. I basically just think that the Russell has more upside, and I'm not too worried if it pulls back here and bounces off, or if it even pulls back here and it bounces off. Like, I'd be happy to hold those trades. So sometimes people will ask, Nick, why don't you trail that stop further? Why don't you lock in more? Trust me, sometimes I wish I had. Like, for example, if we get, a sell down in stocks right now, I'm going to kick myself and be like, dang, I shoulda, coulda, woulda. I wish I put my stop loss here. But you have to think about this. Technical analysis, I've been thinking about this a lot recently. Technical analysis for me doesn't have a ton of predictive power of what the market's going to do next. It's really just a risk to reward measuring tool for me. Like, if I think that this market is going to go up as a big picture, which I do, according to my system, the Russell, I don't know if it's still bullish. Oh, it dropped down to neutral here recently. But the Russell has been a generally bullish instrument in the Edge Finder. We've had the S&P 500, NASDAQ, Dow. Those three are still getting bullish ratings. So I generally think indices are going to continue to move higher. So if my bias on indices is I think we are likely to continue to move higher, right? Then how do I want to play this? Well, I don't want to squeeze this stop loss right here and say, not only do we have to move higher, but we have to move higher right now or I want to get out of the trade. I like to trail stops loosely because if my directional bias is still up, then I don't want to crowd the trade. When I say crowd the trade, I don't want to make my stop loss like right. I don't want to tighten it so much that any sort of normal daily action would get me out of the trade. One way that you can do this that I find to be a really cool methodology for stop loss placement is get your average true range out and go back and basically let me just pull this up and I'm going to just make this a brighter color so we can all see it. Get your average true range out and say, okay, so this thing is moving 13 points a day or every 4 hours on average. So if I'm trailing my stop on the 4-hour chart, right, get your ATR out and say that a 13-point move every 4 hours is about this far, right? But typically what I do is I use the daily chart. So if I'm looking at the daily chart, 39 points per day, right? So 39 points would put us here or it would put us here, right? So let's actually just mark this out because roughly we could have a normal move in the next 24 hours according to the ATR. Let's just call it 40 points in either direction, right? So if I just take that and I say, okay, our normal range is roughly within this, to me as a swing trader, if this is expected, guys, right? We can look at the average true range as a general guide of expected move for the Russell based on the recent, market volatility. So looking at this, take a look at my stop loss. And okay, so we can say like, hey, a normal move could be something like this in the next couple days. If that's a normal move, do I want to put my stop loss within the normal move range? No, not necessarily, not unless I'm looking to day trade or if I want to, if I want to narrow my search a little bit, right? But really, I've trailed my stop loss based on the daily chart. I got down to the 4-hour chart just to look at the zones a little closer, but it's really based on the daily chart, which is where I'm primarily trading the Russell. So try this at home, right? They say don't try this at home. You should try this at home. You should experiment with, play around with the ATR indicator. It's free on all of your major charting platforms, and just throw it on your chart, and you can see what the average daily move for the asset or instrument or stock or whatever that you're looking at will move on a daily basis.